What is happening, investors? It is your boy Jack. Welcome back to another video. It has been an absolutely crazy week, mainly because oil prices went negative and lots of Q1 earnings came out. And this was the first week since I started investing that I did not buy a single stock, just because I'm not very confident in where the market is right now. I don't see many very good deals, and I do believe that there is a lot of room for more red days. It's been quite a stagnant week, at least relative to the last month or so. You know, we've been seeing crazy weeks. Everything was a little bit calmer this week, despite the fact the oil prices went negative. But despite the fact I didn't buy anything this week, I did more research this week than ever before. And today, I'm just in the mood to chill out and chat with you guys. You know, I don't want to go do any really in-depth research. It's Saturday, it's the weekend. I'm in the mood to just chill out and speak with you guys. We're going to be speaking about 10 stocks from 6 different sectors today. So we've
information technology, we've telecommunications, we've consumer staples, consumer discretionary, travel related stocks and oil related stocks.
And since it is 10 stocks, obviously we're not going to be going in depth on each one. We're just going to discuss them very briefly so this video isn't 80 days long. If you enjoy this video, please consider dropping it a like because it helps me out massively. It helps me get seen by more people. Drop me a comment with your thoughts on any of the companies we discussed down below today, and make sure to hit that juicy red button, the same color as this jumper, baby. Hit that and join the family. But let's just get straight into stock number 1 of the day. It's really warm and I don't feel like being a sweaty mess, so now we're rocking the t-shirt. I barely ever wear a t-shirt in these videos. But anyway, sit back, relax and grab yourself a Pepsi Max, baby. The first stock is Pepsi. Again, today we're just chilling. I'm just letting you know what stocks I'm looking at. Most of the stocks today I will have pretty much full videos on. All of them will be in the description. But Pepsi, look at that Max stock chart. It's beautiful. You guys know that I love when I see a Max stock chart that's just up and up and up, as we like to say on the channel. Funnily enough, Pepsi is considered a consumer staple. I thought they would have been a consumer discretionary, but anyway, we're going to start it off with the consumer staples. The big boys, the safe boys, the ones that are generally deemed to be recession proof. I absolutely love Pepsi as a company. I do own these guys. I will show you that now for proof, as we like to do. They have a dividend safety of 93 and a dividend yield of 2.84%. So for a long time dividend investor like me, beautiful first thing to be seen. And it's always nice to invest in a company whose products you actually use, and I quite clearly do. I'm also fond of the old bag of Doritos every now and again. I know a lot of you guys probably like Mountain Dew, Lay's potato chips, man. You already know what it is. A very quick look at the balance sheet. Current assets 17.6 billion, total assets 78.5 billion, current liabilities 20 billion, so ever so slightly above current assets, but it's not the biggest thing in the world to a company as big as Pepsi, and total liabilities of 63.67 billion. So obviously it's a fine balance sheet, not the best in the whole wide world, but given the situation we're in right now, it's good. I would most certainly expect that dividend to be very safe. They have an uninterrupted dividend streak of 47 plus years. That's always fantastic to see. It's at 2.84%. They're going to be able to keep paying it. And we can see that Pepsi is almost back up to its highs. They're not even 10% down from when all of this started to happen. So they're doing a lot better than the market as a whole. As I said, I just love Pepsi. I've compared them to Johnson & Johnson before. Very controversial, I know. But they're a company that I plan on investing and holding in forever. And now we have one more consumer staple stock. And I just hinted at who it is. It is the one and only Johnson & Johnson. Everybody knows who these guys. The large majority of you guys probably have them in your portfolio. If you own more than 10 companies, this is probably one of them if you're a long-term dividend investor, or even just a regular long-term investor. A 99 dividend safety score, a 2.61% dividend yield, and a 57-year dividend streak. And on the note of dividends, on April 15, J&J hikes dividends 6%. Beautiful, they're going to keep paying this dividend. They're absolutely fine. A few of J&J's really popular brands, Tylenol, Johnson's, Aveeno, Listerine. If you're in the US, you definitely know all of these, and even if you're not, you more than likely know the large majority of them. And look where they were when things started to go downhill. We were at $154 at the peak. We're back up to close to $155 right now. And again, it's a company, just look at their Max stock chart. It's absolutely beautiful. It's always going up. This is a company I'm in currently. I do hope to buy more of them. The fact that they're up above where they were before all of this started to happen is quite scary though. That's why they will definitely be on my watch list. I'm hoping that we might see a little bit of a dip just so that I can increase my position. But we'll have to wait and see. They've performed so well. And that is why people in general love these consumer staple stocks. And why I've spoken about them so much in the past is because they most definitely are some of the safest investments you can make. That's consumer staples. That's the safe stuff. Now, let's get to some of the juicy stuff. The stuff that people really love to see. We're going to go on to the travel industry. Carnival. I've spoken about these so much. If you didn't watch my recent video, check that out. You'll know where I stand with them. In previous videos, I said I would not buy these guys unless they got got back down to about $6 or $7, and my mindset has completely shifted. I have been gaining confidence in Carnival as the weeks have been going on. They've been handling things very well. It obviously does still look somewhat bleak, and it especially looked bleak when we saw they had to take on $6 billion of new debt at those 11.5% interest rates. It's all a matter of when they can start sailing again. But these are guys who have so much growth potential at a price around $12. It's insane. On the other hand, the chance of bankruptcy most definitely is still there. It depends when they can start cruising again. You know, if this goes on for the next 6, 7, 8 months, bankruptcy is only imminent. But if they can get back within 3, 4, 5 months, they're going to be in a decent position. I still haven't decided what price point exactly I'm hoping to get into Carnival in. I will obviously keep you guys updated, but as well, I'm not a financial advisor. You should never buy a stock just because I do. I just want to make it really clear that these are obviously one of the way riskier investments you could...
What is happening on my screen?
Anyway, what I was trying to say is, I just want to make it really clear that this is one of the much more risky investments you could potentially make, but I do see that level of risk slowly lowering as time goes on. They're handling things quite well in my opinion. I'm actually relatively confident in these guys at this stage. It feels really weird to say that, but I am. I don't think many people would argue that if Carnival comes out of this on the other end, you know, and they start becoming profitable again relatively soon, within the next half a year or so, that we could potentially see 25, 30, 40, even a $50 share price within 2 to 3 years. And that is obviously absolutely immense growth potential, and is not growth potential that many companies have whatsoever. End of story. And you guessed it, the second stock I'm going to be guessing about in the travel industry is of course Delta Airlines, the stock I've spoken about probably just as much as Carnival on this channel. Another high risk, high reward play, but nowhere near as risky as Carnival in my opinion. Delta is getting a lot of help from the government. I went through their entire Q1 earnings transcript and it looks really good. Carnival had to take on $6 billion of high interest debt completely and utterly by themselves. Delta Airline is going to be getting $5.4 billion from the government, only $1.6 billion of which is a low interest unsecured 10-year loan. The rest of it is completely and utterly interest free. And furthermore, for Delta, they've reduced their total cost base by over 50% in the June quarter. So starting next month, their entire cost base is coming down 50%. All of the information that we got this week, in my opinion, makes Delta a much more attractive company. Again, it's a company I'm in. I keep forgetting to say that at the start. Here is where I stand. Obviously, it does not look the best right now, but my days, am I excited for Delta. This is one that I plan on buying every single week. I was going to buy it this week, but I said, let's just leave it out. Let's wait till next week. I think that the risk to reward ratio with Delta right now is incredible. I think they're far less risky than some of the other smaller airlines. Definitely far less risky than Carnival. And I still see them as potentially, you know, growing from this stock price of $22.40 all the way back up to $40, $50, $60 within a matter of 2 to 3 years, which again is absolutely immense growth. And we're still hovering around a very low point for Delta, which is encouraging me to buy more shares in all honesty. They haven't recovered very well yet. And I just think that soon some sort of at least a short-term recovery has to happen because of all the good news that has come out. I know there's still an awful lot of bad news. They're carrying 5% of the regular amount of passengers they do. They're making far less money, but there is a lot of promising things coming out recently. The third sector we have to speak about today is of course going to be oil. We all know that oil prices went negative last week, down to negative $38 per contract. That was not heavily reflected in a lot of the big oil companies, and a lot of people ask me why, and simply put, when you buy Exxon, you're not buying the commodity that is oil, you're buying ownership in their company. Obviously, yes, they are in integrated oil and gas, but just because the price of oil goes up or down doesn't mean that they're going to go up or down to as extreme a length. And we'll see that right here. Exxon is actually up for the week. Again, I keep forgetting to say this, a company I do own. I'll show you on the screen now for proof, but they are up for the week. And if we just go and look at the chart pre-crash, you know, they were trading around $70 down to $60. Fell as low as pretty much just above 30, and now we're trading at 43. So there's been a fantastic recovery, you know, nearly a 50% recovery, but we're still down an awful lot. And let's speak about the dividend really quickly. 55 dividend safety. I don't think that's very fair. We'll get to that. Dividend yield of 7.96%. So obviously absolutely massive, somewhat because of the fact that the share price has gone down. And lastly, 37 plus year dividend streak. That's a fantastic dividend streak. They're growing it at an average rate, so they haven't just forgotten about it. They are actively growing this dividend and rewarding their investors. It's extremely attractive from an investor's point of view to see that. They want to keep their investors. They don't want them selling their stocks. They want people buying their stocks. If they cut that dividend, it's going to have a heavy impact on their stock price. And we can see that on Friday, Exxon actually outperformed the Dow Jones. They're up 2.7%. Dow Jones are up 1.8%, so that's nice to see, obviously. Now, number 2 in the oil industry is NAT. Just because so many people in the comments are asking me about these guys, purely because of Jeremy from Financial Education. I love this guy, but nobody cared about NAT until he spoke about them. And look what happened when he spoke about them. They have absolutely boomed up in price. Started the week at pretty much $4.3, down as low as $4.16, and finished off at $5.85. You want to see what that equates to as a percentage? 45%. I've already said in previous videos, I don't want to get into oil tanker stocks. The simple reason being, I don't understand them well enough, and I especially don't understand well enough how the fact that there's nowhere to store oil, I don't know how that's going to affect these stocks. I don't know if that's a good or bad thing in the short term or a good or bad thing in the long term, and I'm okay with admitting that. I've said it plenty of times in this channel, I know far from everything. If I ever see a stock go up 45% in 5 days, no way would I want to buy them, man. That is some seriously unhealthy price action. So why am I including them in today's video, 10 stocks I'm watching next week? Because I will be watching them, and I really am interested in seeing what happens. I'm interested in seeing, will they actually start to stagnate? Like, is this price accurate of where it's going to stay? Or will people realize, you know what? I bought this, not having a clue what this company really does. I'm going to sell while I've made this money and get out. Never invest in things that you don't understand. This is something I don't understand. Anyway, that is going to do it for oil stocks today. Now let's get on to the consumer discretionary stocks. Up first, McDonald's, another company I own positions in. Boom, I shall show you on the screen right now. Everybody knows who these guys are. I actually made a full video on these guys as well. Again, it'll all be in the description. They've been around an awful long time. They're the biggest in the world. No matter where you go in the world, you're going to find a McDonald's within 10 minutes. It's that simple. Just having a look at McDonald's, okay? 77 dividend safety, 2.7% dividend yield, decent, 45 plus year uninterrupted dividend streak. Absolutely fantastic, and they've grown it very quickly. The last 20 years, 17% per year. Last 5 years, 8%. Last year, 13%. They're growing this dividend really quickly. So given that it's already at 2.72%, if they continue this rate, there is definitely a stage where this could be giving us a 3.54% dividend yield, which is pretty much ideal for me. That's what I aim to get to. And McDonald's have had a really nice recovery. They were at about $215. Fell all the way down to 137, and we're back up to 184. So again, one of these companies who's already had their, anywhere from 30 to 50% rebound. They are on my watch list. I do want to buy more. I don't know if I will at this price, but if I see some downward movement, I'll definitely be hopping in. I mean, just look at this guy. How could you not invest in that guy? And just having a look at McDonald's balance sheet really quickly. Total current assets 3.55 billion. Current liabilities 3.62 billion. So we're neck and neck. Total assets 47.5 billion. And total liabilities 55.7 billion. So not the best in the whole world, but definitely not the worst in the whole world. Now we're having a look at Amazon stock, and I think everybody knows who these guys are. I love them. I use them so much. I've used them more than anybody else this entire lockdown, but it just doesn't look like a good price to me. We are literally at all-time highs. I do wish that I had have gotten in there when they had that initial dip, but right now the price just is not attractive. But this is probably the company that I most in the world want to get into my portfolio. Now, I don't know if I'm being a bit greedy by not buying them at this price. Maybe I am. I know I always say that you should just buy in dollar cost average. I'm in two minds. I don't know if I should buy or just wait around, and sometimes you just don't know. But I don't believe that we're going to see a big dip with Amazon no matter what happens next. I hope that we see that dip so I can get them very cheaply, but that's not what I see happening. Amazon obviously have immense prospects going forward. The world is simply moving online, and they are the biggest in the game. I mean, let's just look at the balance sheet. 96.3 billion total current assets, 225 billion total assets, 87.8 billion total current liabilities, so they're absolutely fine without question. And then 163.1 billion long-term liabilities. So my days, it's a beautiful balance sheet given the situation we're in. They're not being hit particularly hard. I don't know if they're going to go down or if they're going to just continue to skyrocket up. I want them so badly, man, but I just don't want to overpay. But then I have a look at Amazon's PE ratio, okay? And right now, their PE ratio is at 104.75. Over the past 10 years, the minimum's been 45.1, the average has been 146.39, and the max has been 3700. So maybe it isn't overvalued. But anyway, that was Amazon. We have two stocks left. Let's get straight into them. Staying on theme with the absolute giants, we're looking at Microsoft, another company I really want to get in on. Now, these guys aren't quite at all-time highs, but man, they are very close. Those highs, 187, we're at 174. They are really close. So again, I'm wondering, have I left this too long? Should I have got in earlier? But then again, I just go and look at that NAT Stock chart, and the growth is just absolutely mental. It's disgusting. And then I have a look at the balance sheet, man. Total current assets, 167 billion. Total assets, 282 billion. Current liabilities only at 59.6 billion, and total liabilities 172 billion. An amazing balance sheet, and I am more than likely going to buy these guys. I know they don't necessarily have the biggest discount in the world right now, I fully appreciate that, but the growth that they have shown, these last 5 years in particular even, look at that, man. 5 years ago we were at $48 a share. It's insane. And they have the new Xbox coming out later on this year, which is no doubt going to help them. Released on 26th of November. That's going to be awesome. Look at this. The year of 8K games, man. 8K, who needs that much quality? But yeah, that is Microsoft. They're on the watch list. I'm going to be watching them very closely, and I more than likely will pick up a position in them next week. And the very last one we're looking at is AT&T, a dividend safety of 65, a dividend yield of 7%, and a dividend growth streak of 36 plus years. Now I know there's a lot of mixed opinions on these guys. I do have a position in them. I do plan on buying more positions in them. I personally like them, and that's what counts. On the 6-month chart, we went from around a $40 mark all the way down to $26, and we're currently sitting at about $30. So they weren't hit quite as hard as a lot of the other guys, and the rebound has been decent. So here is a reason a lot of people don't like these guys is last year they had to pay $60 million to resolve FTC allegations that it misled consumers with unlimited data promises. Obviously that's a very bad thing. It put them under a very bad light, and it would defer an awful lot of investors. But they are the biggest telecommunication company in the US as per revenue, subscribers and profit. That is AT&T. They are the biggest of big boys. Verizon is in a very close second. I also own a position in Verizon. Bang, here's that on the screen. But if you know me, you know that I like investing in the big boys, the ones at the very top of their particular industry. And look, I've addressed this in previous videos. The 5-year chart is definitely very shaky, but we were this year just beginning to see some amazing growth, and then this happened. So hopefully we can continue this pattern going forward. So guys, I hope that you did enjoy today's video. There are 10 lovely stocks that are on my watch list for next week. Some that I most definitely want to open positions in, some I'm just watching for the fun of it, and some I may open a position in if they go the right direction. If you watched till the end, thank you so much. I really appreciate it. You are the real fans. You are helping me out massively. Make sure to just support me by hitting that like button, subscribing, and drop me a comment with your thoughts down below. All of those things help me out so much. But anyway guys, thanks again for watching, and I will see you all in the next video tomorrow. Peace.